Welcome to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store and brought to you by Adjemi Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Georgie was mad. He said, Andrew, why are you putting 2% bonds in my portfolio? I don't want 2%. I want 5 or 6%. What are you doing with these 2% bonds? I said, Georgie, come on now. Come on. When is 2% not 2%? When is 2% equal 8%?
When you understand market structure, you understand volatility, you have strategies to be able to benefit from these crazy volatile markets that we've had over the last 2 decades.
Hey, that is a cool idea, Daniel. I think we should talk about embracing volatility on today's show. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. We're going to be talking about benefiting from volatility today. That Georgie was not understanding the benefit of having cash-like instruments providing 2%, a double A bond that was 11, 12-month bond.
Right.
And how was he able to embrace that volatility?
Well, how it worked was at the time, when we bought that bond, there weren't any good CDs, but so this bond was the best thing going. So we made 2% for the year. And then we didn't know what was going to happen, but December of 2018, the markets dropped 25%. The stock market did. So when that happened, we were able to that bond came due. We got that money from that bond, and we were able to take advantage of the volatility in the stock market and do what investing is all about, buying low. And then we ended up selling it higher and ended up making 8%, or actually with the dividend, he ended up making 8% on his money. And if we added it over the year, it was beautiful.
So typically people are terrified, right, of volatility. You were telling me a little bit earlier about somebody who came in and said, I don't want volatility. I just want the money to sit there. And it's difficult because markets really changed tremendously after the great financial crisis, right?
Right. Definitely. All the rules changed.
Instead of letting free markets fail,
mm-hmm.
and then rebuild so that they could be stronger, the powers that be kind of took the easy way out, and they held everything together with toothpicks. And because of that, markets are not so free. And as we can see since then, markets are extremely volatile.
Right.
In the last 2 decades, right, we've had 3 major drops that have been more than 35% to people's portfolios.
Right, exactly. And if we were to lower that percentage to 25%, there'd been 4. Yeah. So
in 2 decades, that's a lot of volatility to stomach. For we'll use a generous number for the S&P and say for 10% return, right?
Right. That's very generous over that period of time. And
that depends on nobody selling in any of those stomach-wrenching drops.
Right.
So that's what most people think about when they think about volatility. And I would agree with them. That does not sound rewarding. That does not sound fun. That does not sound beneficial. But what typically has happened to younger people, right? When I say younger, I talk about people in the accumulation phase of life when they're saving their money.
Right.
That automatically, without thinking, money's coming out of their paychecks.
Yeah.
And participating in that volatility.
Right. And embracing that volatility. Yeah.
People benefited from that. But what happens when you are no longer saving, or you're tired of that stomach-wrenching volatility?
Well, now you have a whole different situation. going on, and you're not taking advantage of the volatility anymore. You're not embracing volatility anymore because you're not putting any money in. In order to embrace volatility, you have to buy, and you have to buy when the markets are low, and that works out well. But if you're not buying, if you're not saving, if you're not investing, well, then that's not happening. And, that's what we're talking about today on today's show, right? Is embracing volatility. And we need to understand volatility is not risk. Many people may think that volatility and risk are equal. Well, they're not. They are not the same. They are not equal. All volatility is not bad. As a matter of fact, volatility, if you used properly, like you said at the beginning of the show, with the right strategies, can be very profitable to people. So, from that idea, Daniel, I'm thinking that we should offer to people in our listening audience lessons learned in the stock market history, because if you learn lessons, the cheapest way to get experience and to learn something is from the experience of other people. So if we learn from stock market volatility, from stock market history, we can learn something to be able to put us in better shape in the future. So if you just turned in, you're listening to Financial Strategies with Andrew and Daniel Adjemi. And today's topic is embracing volatility. And the paper we'd like to offer to you today, if you're so inclined, is Hard Lessons Learned in Stock Market History. If you'd like that paper, please call us at 800-725-7616, 800-725-7616. We'll be glad to get that out to you and hopefully be able to help you learn something the easy way instead of the hard way with your own assets. So, volatility, Daniel, when we're talking about embracing volatility, many times I'll have people come in and they're still working, and maybe will roll their 401k into an IRA so that they can take advantage of the universe of stock market, income generating stock market alternatives that are out there. And but yet they're still putting money into their 401k, and they're taking advantage of that. And so I'll talk to them about how we can use aggressive investments, risky investments, but using a conservative strategy is what I talk about, and how we'll take maybe the money that's, or maybe they're too young to take the money out of their 401ks. And so we'll take the money that's, that they want to hold on to, and we'll make that safe. And then all the new monies we'll put into the stock market and take advantage, embrace the volatility of the market. Because when the market goes up, they'll put money in, and when the market goes down, they'll put money in, and the money that they're putting in when the market goes down, is called dollar cost averaging, will actually jump up when the market goes up to be able to take advantage of those things. And that's one thing that we can do with people while they're in their retirement, though, too, isn't it, Daniel? I mean, even though they're not investing, depending on how they have their strategies and how they have their investments set up, that's a beautiful thing to be able to do for them. Correct?
Yeah, I think most people understand, even if they don't know the terminology behind it, the dollar cost averaging, right? Because most people have participated that kind of by happenstance through their 401k plans.
Yeah.
And so when we're talking about embracing volatility, we are not talking about taking excessive risk.
Right. Right.
Not at all, because that's foolish. That's going to the casino.
Yeah.
And so typically when people come in and they say, I don't want to risk my money, and they view volatility as risk.
Mm-hmm.
And they would be right on a lot of indexes, a lot of US equities right now, because what's happened over the last 2 decades, right, is money from all around the world and passive funds. Right, passive funds meaning dumb money, where no one's doing evaluations on the company in the index, looking, oh, this is a good price company, this is a good valuable company, this is a company that has great future growth. It just says, here's all the stocks that are the largest stocks in the US, so all this money is going to flow into them, and the higher they go up, the more money goes into them.
Right.
Now, does that sound like a good investment philosophy, like buy low, sell high? No, by design, they're buying the highest priced companies, because the higher the price of the company goes, the more money gets funneled into that. They're not equally weighted.
Right.
And so what's happened to US stocks, especially the ones in the major indexes, is they keep having multiple expansions. So instead of the earnings getting larger and larger and larger and larger as the shares go up, so you're getting more dollars of earning for every share that you own. What's happening is people are paying more money for either the same or less earnings coming into the company, because they're either doing the multiples are getting bigger, right? So instead of paying 4 price per earning, you're paying 85 price per earning, or whatever those numbers are, right? And so that kind of volatility doesn't make any sense, because you're betting that someone will pay more for that than you're willing to pay for it. That will drive the multiple up, and that will drive the price up. Or you really think that these companies are going to expand their growth when the top 6 companies in the S&P 500 make up over 20% of the S&P 500, and they're almost, some of them are $1 trillion companies, some of them are very close to. So you think their multiples are going to expand when it's that large of a company, right? So that's what we're saying, is that type of volatility is a very risky way of investing.
Just because something costs more doesn't mean it's a better value. Right. So if you got a $50,000 Lexus, and because there's such a short supply of Lexuses today, the dealer has one brand new Lexus on his lot, so he's selling it for $60,000. Does that make it a better value because it costs more? No, but it's a supply and demand situation, so he can get $60,000 for it because somebody will pay him because they want a brand new Lexus. But wouldn't it be better if you could buy that Lexus for $45,000? Now that's a value. It's a $50,000 Lexus you're buying for $45,000, right? That's where the value comes in. But the stock market is overpriced, which is driving the risk up. So when it comes down and volatility happens, that doesn't mean it's time to buy more of the same old, the herd mentality stuff, the S&P 500. You got to look at where the values are and buy the values, right? So you got to embrace volatility, but with the right strategies, the right mindset.
That's where that strategy comes in, because when you are in retirement or serious about retirement and it comes down, we've trained our brains to think it's just going to come right back because the Fed kind of manipulates markets and gets them to go back up. But there's 2 difficulties once you're serious about retiring and retirement with that strategy. Is one, do you have money to put in? Because if you're not saving any longer, where does the money come from to put it in the market? And if you're saying, well, I'll have cash sit on the sidelines so I can benefit in that, well, then you have cash that's actually in real terms losing money so that you can participate in that. And that doesn't make any sense. Plus, it can mess up your lifestyle because you're not having the income, right?
Right. Exactly.
And then that second part is, well, we're trained that they always come right back. But what if it takes 2 years to come back? And you used your cushion cash, right, for buying opportunity to buy the dip, but it took 2 years. Now you're selling your equities at a lower price to maintain your lifestyle. It doesn't need to take 10 years, which has historically happened in markets where they take 10 years to come back. A year or 2 could really mess you up.
Right. And, so you're talking about strategies. And that's what this show is all about, financial strategies with Andrew and Daniel Adjemi. Today's topic is embracing volatility. And we're going to need to take a break here. But before we do, we want to offer you a book that, is a little outdated. It was written in 2011. But the concepts and the principles in this book are very good. It's called Financial Insanity. by David Scranton. And David's a friend of ours, partner of ours with our Connecticut office. And we're glad to be able to give this to you because this book will educate you. It's a very easy read. It will educate you on some of those things so that you can learn from stock market history. You can learn from the experience of other people so that you don't have to. It's a great read. We'd love to put that in your hand for the next 5 callers at 800-725-7616. 800-725-7616 for Stop the Financial Insanity. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
Dad, I heard a story the other day, and it's so true. So typically people, right? We get excited about sales. If Tiffany's has a 50% off sale, right?
Yeah.
You're going to run in there, you're going to buy some jewelry, you buy some nice stuff, you're going to save that, you're going to know in the future it's going to be more valuable. You want that, right?
Right.
You were talking about the Lexus earlier, and same with really Christmas present shopping, any of these kinds of things. When you see a sale, you want to take advantage of it. We're trained to get excited about those sales and take advantage of them.
Good values.
But in investing, we're all backwards. Right?
You're right.
We're 100% backwards because whenever there's a sale on assets, right?
Yep.
People run away.
Yep.
People run away. People say, no, I don't want to participate in that. That happened the other day with a friend. He was like, it's down. I don't want to buy it. Yeah, well, if a bike was down, would you buy the bike if it was on sale? Yeah, I would. So these things trick people. The sales and markets trick people, whereas we really understand sales at Tiffany's or bike sales or shopping sales. I'm Daniel Adjemi.
And I'm Andrew Adjemi. You're listening to Financial Strategies with Andrew and Daniel Adjemi because people don't know what people don't know. How many of you have thought about that before Daniel brought that up, how we're trained to embrace sales, but we're not trained to embrace sales when it comes to the stock market and volatility in the stock market. That's what today's show is about, is embracing volatility. And that's where the deals come. That's where the money is made on that standpoint. You're not going to hear this from a lot of people, but you are here on Financial Strategies because people don't know what people don't know. Daniel, that's a great story on that. I love that concept that you're talking about with, you buy a bike on sale or this on sale or jewelry on sale, that on sale, but people just don't get it when it comes to the stock market. The only times they buy it on sale, most of the time, is by accident rather than on purpose, right? And that gets me to the concept of people make decisions both by on purpose, by they make decisions on purpose because they want to make a decision, but sometimes they hem and haw and they don't make a decision, which itself is a decision by indecision. And so that's what we're trying to, the whole aspect about investing, about business, about anything when it comes to making money is buy low, sell high. In order to do that, you have to embrace volatility, right?
Right. And with that caveat that we're talking about embracing the right types of volatility as well as the strategies so that you can, because again, it changes when you're not saving anymore. You have to create income streams in order to have cash to embrace that. And like we said, if equities in the US are far, far, far overpriced, if indexes are far overpriced, and you could argue if they're overpriced or not, a lot of people do. But when you look at the multiples of company, you're not getting a lot in return for your money, right?
Right.
So we're talking about very niche special situations of embracing volatility, right?
Right.
Because you can't afford permanent loss as a retiree. You can't afford to have markets take a year, 2 years, 10 years to come back. So we're not talking about stock market volatility, embracing that. If you are serious about retirement, in retirement, about to retire, right?
Right. Right.
We're talking about special situations like an example would be the way that a corporate bond works
Yeah.
is it's a contract that you
Mhm.
can go out in the market and you can buy. You could either buy directly from the company or you could buy it from on markets that trade, right? And so if you are buying we'll call it a 5.5% bond, that's the coupon. Okay. $10,000 matures in 6 years. What that means is you're going to pay $10,000 at par. They're going to pay you $550 a year. And in 6 years, you get your $10,000 back. So you collected $550
Nice.
every year.
Sweet. Yeah.
And at the end of 6 years, you get your money back. So you could do whatever you want with that $550. You can spend it, you can give it to the grandkids, you can reinvest it, you could give it to your favorite charity. You can pay
Right.
taxes with it. You do whatever you want,
Right.
right? But you know you're going to get that $10,000 back at maturity. Now, when we're talking about embracing volatility, it'd be nice to buy that right now, but you can't buy a good company right now, today, paying 5.5% for 6 years.
Right.
But you can when there's volatility. So you might
Yes.
right now have to pay 112 to buy that, right?
Okay. $112. Uh-huh.
Yeah, which means you're going to lose money when it matures.
Right.
So in that situation is even though you're getting that $550 because of what you paid for it,
Yeah.
your yield to maturity
Mm-hmm.
would only be 3.2% because
you get
you're getting the coupon. You can still do whatever you want with that money,
yeah.
but you're going to lose a little bit of money when they buy it back from you.
Because you're getting part of your principal back. When you're making that coupon, when you're getting that 550. Right.
Right. Exactly. So two things that does. One is that always gives you cash on the sidelines to spend. So obviously we want to make more than 3%.
Right.
But that could play into a strategy like you were talking about with that 2%er bond, because if that comes due or it gets called early, then you can have that $10,000 to buy into something at a lower price.
Exactly.
Or you can build up that cash in order to take advantage of volatility. When we're talking about volatility is if that comes down to 90.
Yeah. Yeah. Take advantage then.
You can buy it at 90. You're going to get 100 for it when it comes due in 6 years, which just brought your yield to maturity from that 5.5% coupon all the way up to 7.6%. Now you're making 7.6%, and you know you're going to make that because they're going to buy it back from you.
Right. Right. And I know there's people in the audience saying, where are you going to get 7.5 or whatever, 7.6% today, or even to 5.5. But the point is that we're trying to talk today about embracing volatility. And if you're able to embrace volatility, take advantage of volatility with the right strategies, you'll be able to get deals when they come about at whatever the best rates are. But you're listening to Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know. We have a paper that we'd like to put in your hand that will help you educate you on some of these things we're talking about today and how to embrace the volatility of the market with lessons learned in the stock market history. So if you'd like that paper, please call us at 800-725-7616 and just ask for the paper, the stock market history paper, and we'll be glad to get that to you as soon as we can. And hard lessons learned from stock market history. Daniel, I'm reminded of buying in the market, the volatility aspects. And part of the whole idea that comes to my mind is that I know in the past, we've talked to people about, this is not the best way to handle it, but, having money in cash to be able to take advantage of buying opportunities, be able to take advantage of volatility. Now, nobody likes to have money sitting around doing nothing, but sometimes having it in cash doing nothing is the only way or the best way to go. But one of the things that I say to people when we're talking about that is the aspect of, having this money in cash is kind of like the sacrificial bunt in baseball, where the batter gets up, the bases are loaded, and he's told to bunt the ball because it's going to bring people home, or he's going to get on base, whatever it may be. It's not going to help his batting average, but it's going to help the team as a whole, right? Because why? Because the cash is there to take advantage of the buying opportunity that can give you a home run at the right time. So whether it's 2% turning into 8% or it's 0 turning into 10%, whatever the case may be, taking advantage, embracing volatility, right?
Yeah, that's obviously not the ideal way of doing it, and that's why you build strategies, and cash can be a strategy, especially when there's a lot of uncertainty. But there are a lot of other strategies, so you don't have to have cash, right? There's guaranteed income products that can produce a income that you can depend on, that can pump money into maybe an account that is has some of these kind of corporate bonds or international dividend stocks or some of these BDCs or preferred stocks that have a little volatility, right? Maybe a quarter of regular market volatility.
Yep.
But if you can have cash that comes over, so it's working over here for you, but it's going to come over each year or quarterly or whatever that is, then you have cash, but it wasn't cash doing nothing for you. It was working for you. And now it's available to you to participate in the volatility. And that bond example, you said, well, where are you going to get 7.6%? Well, that's embracing volatility. That happens when spreads blow out. That happens when there's volatility. So you have to have your mind prepared. You have to have strategies prepared ahead of time.
That's right.
So that you can participate in those, because it will take too long to get the money there if you're not already prepared ahead of time to buy those, because they don't last for a long time. But the good thing is you're locked into that for 6 years. So you have all the options. You can get out of it.
Yep.
But you could also keep it for the next 6 years. So you don't have to have these happen all the time. But we've been seeing market corrections about every 3 years. So if you can buy these really good deals every 3 years when there's volatility, you're set.
That's right. Daniel, I love your enthusiasm on that. I'm right there with you on that. And that's why we call this show Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. And we're talking about strategies, and we're talking about embracing volatility and making sure that you have the right strategy. And if you're just turned into us, one of the things to talk to, if you have a financial advisor, do they have a strategy for what they're doing here with your money? Do they are to embrace volatility, or are they just investing in the market and doing what the herd mentality is doing? And that's what you have to ask yourself. If you're doing it yourself, do you really have a strategy, or do you just investing and you're just doing the old buy and hold kind of situation? Well, that's not embracing volatility. We like to put a book in your hand today. It's called Stopping Financial Insanity by David Scranton. And this is a very simple, easy read book. If it takes you if you're a slow reader and it takes you more than 3 hours, that's going to be a long time. But this is a good book that gives you some good policies, some good information that you can use to create strategies to be able to embrace volatility. We'd like to put this in your hand to the next 5 callers at 800-725-7616. 800-725-7616. We'll be right back after this with how you'd be able to embrace volatility.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, Are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Adjemy in Connecticut and Daniel Adjemy in Colorado.
Henry came in and didn't have enough money to retire on. He said, Andrew, I don't have enough money for retirement, so I need to increase my risk so that I can get more money in order to retire in a few years like this. And I said, Henry, hold on. People often equate increasing risk with increasing your return, and that those do not equate, because if all you had to do was increase your risk and you'd increase your return, it would not be risky. But what we need to do, Henry, is take advantage of the volatility that's available. And by taking advantage of the volatility, we're going to be able to increase what you're going to have for your retirement income. I'm Andrew Adjemy.
I'm Daniel Adjemy, and you're listening to Financial Strategies. Today, we're talking about benefiting from and embracing volatility. And that when we are talking about, people like Henry, a lot, you hear that a lot. That's a very common thing. Well,
right.
We better take on some more risk so we can get more return. And like you said, by definition, if you were guaranteed to get more return, it wouldn't be risky.
Yeah.
So it doesn't
That's
work
right.
that way.
Nope.
And so it's not about what you pay for something. It's about what you get in return for what you pay, right?
Right. What's the risk versus reward? But, volatility is not risk. And people will often equate volatility and risk as being the same thing. And those are not the same thing. And volatility is not the same and is not equal to risk. So with that, the key is when when we talk to people in and close to retirement, I try to encourage them. The sooner we're able to start setting their money up for retirement, the sooner and the better that they'll be for retirement. And why is that? Because we're able to take advantage of the volatility, not stock market volatility, because that's another thing. That's just hope. That's the casino stuff. What people in and close to retirement need and want is guarantees and promises. And when we invest for income, the chicken and the egg scenario, is invest so that we can get those eggs. We got those eggs coming in that we can use to buy more chickens, and we can use them to eat, or we can give them to the grandkids, so that the grandkid can eat, or whatever we want to do, or we can give them to the government to pay our taxes, right? But we need to be able to take advantage of the right volatility, and the stock market is separate than what we're talking about because it's a different scenario, right, Daniel?
Yeah, absolutely. And that actually brings up another way that we really benefit and like to take advantage of volatility. It was one of our favorite ways, right? It's where we have an asset, and these typically are in corporate bonds, but they could be in different things. I explained earlier how the corporate bond works.
Right.
And so if its par is $1,000, right? So you have 10,000.
Right.
At X date when they buy it back from you, you're going to get how much money?
10,000.
Cool, right?
Yeah,
you could get more than that,
right?
Because it could go up and you could sell it,
right?
But you're going to get $10,000. So in volatility, right? VAR shocks happen more and more often, right? Just stop, close your eyes, think about all of the volatility we've had over the past decade. Okay. Did you benefit from that or did you not? Well, with this, if that $1,000 bond came down to 900 or 800, how much are you going to get when it matures?
$1,000.
So if it's 800, it's a 20% discount.
Yeah.
So what would happen if you just said, hey, let me convert this $1,000 asset that is currently at $800 to a Roth. You just moved $1,000 into a Roth with only paying tax on $800.
Cool.
Plus an income stream, because if that's 5.5%, you're collecting $550 no matter what the price is. And now all that $550 a year is tax-free.
Nice. Nice. That's a great way to take advantage of volatility. And, I'm thinking of, how we did that but last March when COVID happened and we were able to take advantage of, I should say, actually, it's a year ago, March now, right? But we were able to take advantage of volatility with COVID, where we had a lot of people that had money that did not go down. It was making 3, 4, 5%. It did not go down. We were able to take that money, take advantage of opportunities. So now they not only getting a dividend now instead of interest of 3, 4, 5%, they're getting a dividend of 5, 6% on their money, 7% in some cases, right? Plus the growth on that money. So if we invested $30,000, it actually went up to maybe $40,000 plus the 5, 6, 7% dividend that they're getting on the $30,000. So it was a beautiful thing because they were able to embrace volatility, take advantage of what was before them. And that's what we're talking about on today's show. You're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is embracing volatility. And, we have a paper that we have produced to be able to give you today called The Dangers of Spending Down Principal During Retirement. Because if you're not having the strategies to embrace volatility, you can actually spend down your principal and it work against you instead of for you. So we want to put this in your hands so you and our listening audience can take advantage of embracing opportunity rather than being caught by depleting your principal. 800-725-7616, the spending down principal during retirement. Ask for it by name. You're listening to Financial Strategies because people don't know what people don't know. Daniel, what else do people not know what they don't know? Or I saw you smiling during that, talking about that embracing volatility with what we did with people last, the other year, 2020 with COVID. What were you smiling about? Or what do you have to say to us about that?
Well, I remember that very well. When COVID initially happened, we pretty much didn't sleep between, going over, making sure everybody's portfolios were positioned properly, and then getting people on phones, having conversations with them about the options of taking advantage of that volatility. And, we talked to a lot of people, and some chose to embrace the volatility and they've made a ton of money. Some said, nope, I just want to keep the money safe. I like that I didn't lose anything. I don't want to, and both are fine depending on you. That's why we're trying to bring these strategies to people's attention before things happen, so you're in a position to take advantage of that. And asset allocation is very important when we're talking about this, because some of the things are more volatile, right? Some of the income producing assets that we're talking about work differently. Right. And some are more volatile, and you don't want to have too much volatility in your portfolio because that causes emotional problems when there's too much volatility.
That's right.
And so some of those things are up over 100% plus a 20% dividend for people who took advantage of that volatility. Now, that was a crazy happening. So I'm not saying that people should expect that going forward, but the point is that the people who took advantage of that were able to get ridiculous returns plus lock in this income, right?
Yeah.
And so that's where that asset allocation is so important, where you get the things that are able to stabilize your portfolio, and you get some things that can give you a little bit of inflation protection and asset, inflation protection, so you don't get left behind. If your monies are in the bank, just, burning as inflation goes up and up and up.
Yeah. Well, people are out there listening to us right now that are not embracing volatility. They're not taking advantage of. They're not being positioned properly. They don't have strategies in place that are going to make it so that they know what's going to be happening, and they're going to be in a better position in the future. Some people listening to us they're scared to take advantage. When there's movement in the market, they're scared of things. But some people jump on that. What do you how do you address that? What do you say to somebody like that that's not in that position that they should be in, Daniel?
Well, there's some people who are just like, they've already embraced market volatility, and they're crazy about it. They have cash sitting there. They just want to buy dips and buy the S&P and buy crazy stuff, right? And we're not talking about that. We're talking about you go do you, right? We are talking about things that have contracts or promises associated with them. So you're taking the hope out of the situation. So if
and adding a certain amount of certainty, correct?
Right. So the two things is one, allowing you to participate in volatility, because if you owned, call it the S&P in 2000, it dropped, right? It dropped what, 50%?
Yeah.
And then came back right to where it was in 2007. Then it dropped 60%, and then came back to where it was in 2013. Now, were you able to take any kind of advantage of that? If you owned an S&P fund, you would have had 13 years of nothing. And if you needed money to live or RMDs to take in that time period, you never would have got back to where you were in that period.
Right. Exactly.
But when you talk about these kind of income producing assets, you're able to increase your annual income, right? So if you're generating $50,000 off $1 million, and you can spend that $50,000 every year, if you're able to take advantage of some of these dips, like in that situation, then you could turn that into 60 or maybe 65,000, right? And you take care of that advantage to bring that income up, which either gives you more spending power or gives you extra income to keep taking advantage of that stuff.
Yeah, it's a beautiful thing. And, I'm thinking about, just today we're talking about on financial strategies with Andrew, Daniel Adjemi, embracing volatility. And we hope that you're receiving some good information from this. We trust it works well for our clients because they're set up for this. And we hope that you'll be able to understand how this all fits into everything. And because of that, we have a book that we think will help you to understand this a little bit better and put it in a place in your situation. It's Stopping Financial Insanity. Don't let the Wall Street's cancer spread into your portfolio, by David Scranton. We have this book for the next 5 callers at 800-725-7616. It's an easy, good read book that's going to be able to help you, if not know what to do, at least know what questions to ask. So 800-725-7616. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to Adjemi.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
In April of 2020, I was reviewing my client Sally's account with her, and we were talking about her accounts, and we recognized that she had money that was safe, hadn't lost anything, was making a little bit of money on it, 2-3%, maybe somewhere in that vicinity. And we talked. I said, Sally, you got this money that's not working very hard for you. They only making maybe 2 or 3% on it, and this is a great time to embrace volatility with what's going on, and you're going to be able able to make 6-7% of dividend every year plus appreciation with it. You're going to take on a little bit more risk by doing this, and a little bit more volatility, a little bit more risk, but you're going to be able to take advantage. The risk is going to be worth the reward. Oh, Andrew, I don't want that. I don't want to risk any of my money. I'm tired of that. I've been there, done that. I don't want to do that, she says. Sally, it's going to work well for you, and you can embrace this volatility. Well, Andrew, isn't there a different way that I can embrace volatility without having to put my money at risk? And I said, well, as a matter of fact, there's this other way that you can take advantage. When the market goes up, your money goes up, but when the market goes down, your money won't go down. And so she said, that's what I want. That's what I want. So we did that. And then in April of 2021, she had made approximately 15% on her money over that period of time. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we're talking about embracing and benefiting from volatility. That's a great story, because we've been talking about some of these bond-like instruments that, maybe they do a quarter of what the S&P does, right? So they're minimal volatility compared to the S&P 500.
So you're talking, when you say, Daniel, when you say quarter of, you mean the quarter of the volatility of the S&P 500?
Yeah. So yesterday the S&P dropped 2%. So maybe these portfolios moved, 0.4%, right? Right. So that's what I'm talking about. But some people don't want even that, right? Some people don't want to experience any volatility. So how can someone benefit from volatility without experiencing the volatility themselves?
Yeah, well, you put that off on somebody else that is in the business of taking on that volatility, taking on that risk for you. And then what they'll do is they give you part of the growth, they'll give you part of the upside, but they're going to shield. They won't give you 100% of the upside, but they'll give you a piece of the upside while shielding you on the downside. It's a beautiful thing. And that's what Sally did. And she loved it. And now she's 15% ahead. And now whatever happens this year, even if she only makes 5% this year, or even if she only made 2% this year, it's on top of and is compounded on the 15%. Phenomenal.
Right. So that goes back to that whole thing where you're talking about just because you're taking on more risk, people say, let me take on risk so that I can get a higher return. That's a perfect example where risk-adjusted return is actually the most important thing, because if you're making averaged 5% without taking on any market risk, that's pretty incredible, right? I mean, that sounds too good to be true. So let's dive in a little bit on how people are able to do that, how these contracts work, because it's a contractual guarantee to the purchaser.
Guarantees.
Of protecting your money from market loss, from market loss. Experiencing the ups and downs in the markets, right?
Well, you experience the ups without experiencing the downs.
So percentages really trick people, right?
Right. Yeah.
And averages trick people.
That's right.
One of my favorite things is did you hear about the 6-foot man that drowned in the 4-foot on average stream? Right. So in 2000, the market dropped 50%. And if we asked, how much does it have to come back to get back to even? Well, if you lost 50%, you need 50% to get back, right?
Nope.
No.
Nope. Need 100% to get back to even. If you have $1 and you lose 50 cents, you need 100% of that 50 cents to equal $1 again.
Okay. So if you had $100 and it dropped 50%, you went down to $50,000. And then it goes up 100%. and you're back to even. So you just had a stomach being 50% drop, waited for the markets to come back 100%, and you didn't make a dime.
Right.
Unless you were able to participate in that volatility, right?
Yep.
So how would those contracts that you're talking about, where the insurance company takes on the risk for you, how would that benefit from that volatility in that example in 2000 markets dropping 50% and then coming back 100% to 2007 where they were back to even?
Well, if you got, let's just say you got, 25% of what the market did, right? So the market dropped 50%. And if your money was in the market, your let's say it was $100,000, went down to $50,000. And then it took 7 years for the market to get back to where it was. So over that 7-year period of time, you made zero. You still have $100,000 7 years later. But if you did one of these and the market dropped and you only got 25% of what the market did, and the market went up 100%, that means you got 25% on your money over, over that period of time. If you got 40%, well, then you would have made 40% on your money. So with that average, it's a 3, 4, 5%, depending what kind of how much you participate, which is, if you don't lose anything, you don't have to make a lot to keep up and to be ahead of things if you never lose anything. So your $100,000 at the end of that period of time could have been $125,000, $140,000, where everybody else is just at $100,000.
Well, that, I guess, brings us back to that commission report that we put together, right? The dangers of spending down your principal in retirement.
Yeah.
And people can get that by calling us at 800-725-7616, or you could send us an email, office, like where you work, at adjami.com. So that almost sounds too good to be true, because so you're saying that if you had $100,000, you don't lose any of it when the market dropped that 50%. So your 100 stays intact.
Yeah.
But you participate in that 100% move back. So somebody who's taking on all the market risk in that 7-year period made nothing.
Right.
They just got back to even.
Yep.
100,000, 7 years later, 100,000 with taking on all that ridiculous risk.
Right.
And you're saying that the insurance company will take on
that risk for you,
the volatility for you. So you stay at 100,000 when the markets drops 50%, but then they come back 100%. And if you could participate in 25% of the earnings, the insurance company would get to keep whatever they made, and you would make 25% or $25,000 in this scenario.
Right. Right.
And that's simple interest. It could actually do better because of compounding interest.
Yeah. Actually, with compounding, depending how that worked over that period of time, it could have been closer probably to 37%.
So how come people don't know about those kinds of things? What's the story behind that?
Well, it's Wall Street, right? Wall Street doesn't like those kinds of things because Wall Street's whole agenda is to have Wall Street makes money when the market goes up. Wall Street makes money when the market goes down. Wall Street makes money when the market goes sideways. So they make money all directions. When does the typical Wall Street retail investor, make money? Only when it goes up. They don't make it when it goes down sideways, right? So Wall Street's whole agenda is to have as much of their money have as much of people's money in the stock market for as long as possible. Because the market always goes up, they say. Well, guess what? It does for institutions, but not for individuals. The individual retiree is going to die someday, but institutions go on. And so for Wall Street, that's a great business scenario. And they've been just touting this information and spewing out this information that people believe it. And as a result of that, they put their money in the market and it's in there and in there, but when they need it, it may not be there. And so they can spend down the principal. Thus the report that we're giving out to people, don't spend down the principal. But Wall Street's whole agenda is to have as much money in the market for as long as they can. So they don't like this because the money that you have is going to an insurance company. It's not going into the stock market. So therefore, they don't like insurance companies. They're on the outs with insurance companies. But insurance companies can provide guarantees for people that they can't get in the stock market. And for some people, that fits. That doesn't fit everybody. That's why there's companies out there saying, "Oh, you got to invest in the market forever." Well, it's a Wall Street mentality. It's a Wall Street business model, and what people need is the stuff that's going to fit them, not Wall Street. So, with that, I see that we're running out of time today. Daniel, what do you have to say as we finish up here today?
Well, hopefully, some of these strategies we talked about gave some people some ideas and gave some people some hope, right? The folks listening gave them some hope, because there is another way, and it's insanity, just like that book we're giving, right? Financial insanity. It's insanity to think that by doing what everyone else is doing, by what's pushed on you by the salespeople in Wall Street, that you're going to be able to have that stress-free retirement, right? And so you got to look at these other options and how you can embrace volatility. And it's a mixture of these things. So typically people, it's not one of these things that we talked about today. It's using them together to have a strategy where you're able to benefit in volatility while giving you a more dependable income stream and helping you have that risk-adjusted return that is actually outperforming all that crazy market volatility or crazy market risk.
Your financial strategy is important, and people don't know what people don't know. You've been listening to Financial Strategies with Andrew and Daniel Adjemi, and we're glad to have had you with us today. Today's title has been Embracing Volatility. We've got this book that we'd like to give you, Stop the Financial Insanity. Don't let Wall Street's cancer spread into your portfolio. We'd love to put this in your hand. Call us at 800-725-7616, 800-725-7616 to get your free copy. The next 5 callers, 800-725-7616. Until next time, we wish you a stress-free retirement.